Morning, everyone. Thank you for joining this month's webinar, October webinar. I don't know about everyone else on this call, but I can't believe that we're already in October. I'm not sure where September has gone already. You've got shorter days, colder weathers, and I think a lot of us will be back to wondering how long we can keep the central heating off before the house is getting too cold. I have a little bet on with my family who will be the first to give in. The rest of the family, particularly the children, are confident it's going to be me that I give in early. But joking aside, it's actually a really important point that while the war on inflation in the UK and globally, and that's what's important for today because we're talking about currencies, it's relative. That war on inflation has largely been won. There's a few skirmishes to still be carried on, but it's really going to be about what the peace is like after winning the war on inflation. And we think that that will be very much a function of the monetary policy easing cycle in the UK and globally. So how quickly and how far central banks like the Bank of England can lower interest rates as they become more confident that inflation is coming lower. And that's very important for currencies because there's lots of things that influence currencies individually at various times, but one of the main drivers is interest rates and the expectations for interest rates in the future. And that will be a function of that war on inflation. And we expect it to continue to be the main driver in the months ahead, over the next quarter, over the next 6 months. And it's going to be front and center, I think, with the dollar outlook in particular, but very much for sterling as well. And we come into today's webinar with sterling having been the best performing global currency this year. It's continued its good performance both in September and in Q3 as a whole. It lost out a little bit to the Japanese yen, for example. That was a very specific story. The Australian dollar has been a little bit stronger. That was very specific to Chinese stimulus. But I just want to spend just a little bit more time in this webinar just thinking about what the drivers behind that rally in sterling, hence the title of this webinar, Taking the Temperature of sterling's rally. With that, I'll move on to our first slide. So when we came into 2024, one of the key themes that we had here at NatWest Markets for the sterling outlook was that the outlook had become a little bit simpler, that there wasn't a necessary sort of focus on specific risks for the UK economy. If we had held this seminar at any time over the last 5 years, we would have probably spoken about Brexit, COVID, the energy shock within Europe, all expected to hit the UK particularly hard. And we would need to understand those drivers for the currency, whether it was an excessively price risk into the currency, i.e. the currency was weaker, and whether that would unwind. But at the beginning of the year, we thought that a lot of those major risks for sterling had fallen by the wayside, and that the outlook was very much going to be relative growth and relative interest rates. And that's what we think has been driving the currency. So these two first charts, I think, highlights the key driver of sterling's recovery. So the left-hand chart is the relationship between sterling dollar and where markets, financial markets, think the Bank of England and the Fed policy rate will end 2024. And the relationship is particularly tight, and you can see that since the sort of end of the first quarter, markets have become more confident that the Fed is set to cut interest rates more quickly than the Bank of England is set to cut interest rates. And that interest rate differential traditionally has been important for currencies, and it's been particularly important for sterling at this point. And the right-hand chart just illustrates that in a little bit more detail. So you can see the sort of yellowy line is where the Bank of England has been taking interest rates. You had a plateau in rates, but now markets expect rates to come down. The purple line is the same for the US interest rate outlook, and you can see that markets expect rates to come down more quickly. And that's something we're going to explore in a little bit more detail when we look to the future. And we would expect this relationship, importantly, to hold into the year ahead. And if we can move on to the next slide, please. So I mentioned that there was two drivers of sterling. We thought there was going to be. One was interest rates, and the other one was the relative economic performance of the UK. And this year, although it hasn't seemed like it at various points, the UK has actually outperformed very pessimistic expectations. So this chart shows how the consensus, what market economists are expecting for the UK economy, the US economy, and the Euro area economy this year in 2024. And you can see that running into this year, markets were becoming more pessimistic about the outlook for all three regions. But as we got into this year, one of the stories has been the outperformance of the US economy. That's the purple line. So their markets are expecting the economy to grow by about 2.5% now. And the red line shows where the UK is expected to go. So you can see that since the first quarter, markets have become ever more confident that the economy is going to grow, and they think it's going to grow by about 1%. So as I say, it's not a strong performance relative to the past. We normally expect the economy to grow by about 2.5%. Markets are expecting 1%, but it's certainly been better than expected. And I think for some respect, this is households doing a little bit better than feared. They found a way to keep on spending, or they found a way to keep on spending. And the other driver, I think, is perceptions of political stability. I think it helps consumers and households plan, businesses plan to invest in the future. And I think that's reflected in a bit more optimism around the UK economy. In terms of that political stability, I think that when you compare the last 5 years to what we should expect in the next 5 years, I think the political backdrop, whatever you think about the mix of tax and revenue and borrowing, I think is going to be supportive of growth, and that can help the currency. Can we just move on to the next slide, please? So as we look to the future, we think that there is potential for the Bank of England to not cut interest rates as quickly as markets expect, and crucially to a point that is higher in the future. So the end point of the cutting cycle in the UK is set to be higher. So this left-hand chart shows the UK policy rate, and in the future, what markets are pricing, which is the light blue line, and what NatWest economists are expecting. And they think that the Bank of England will cut rates less aggressively and to a higher point than the rest of the market. And as rates adjust to be more in line with the NatWest view, we'd expect that to be supportive of the currency. And at the same time, we think that the Fed, the US central bank, will cut rates more aggressively. So they've already started 50 basis points of cuts. We expect them to cut another 100 basis points, so 1% off the policy rate by the end of the year, and further cuts next year. So that right-hand chart shows the gap between the UK outlook and the US rate outlook is set to widen, and we think that that's going to be supportive. Another point plays to this idea of political stability here in the UK. So over the last 5 years, international investors might have avoided buying UK assets, allocating capital to the UK because of political uncertainty. It might mean that they don't own as many UK assets as they have traditionally have done. And if they buy into this idea of political stability and that valuations appear relatively cheap when you look at price to earnings ratios relative to other economies, they might be expensive at absolute levels, but in relative terms might be relatively low. That money flowing into the UK, and if international investors don't hedge it, that would be supportive of sterling, we think. So we've got two, I think, drivers. We've got interest rates being supportive, relative growth, and that relative growth story held by political stability. So what I'd like to do now, just very quickly run through some of the risks that we see around this more positive view on sterling, and the one that the markets have held as well. So if we can move on to the next slide. So risk one really is about that relative resilience of the UK economy. The Bank of England has cut rates, and we think that they continue to cut rates slowly. But the actual impact of the overall setting of monetary policy is going to get tighter as people reset their mortgages. There's still lots of people on 5-year fixes that will have fixed at sharply lower rates. And as those mortgage terms come up for renewal, they'll be resetting higher. So this left-hand chart, the red line, which is the effective mortgage rate, so that's exerting on the economy, even though the policy rate is coming down, is set to weigh on the economy. And the risk is that in 2025, households reach a breaking point. There are already signs of weakness in terms of households increasing their precautionary savings, but it's definitely something to watch. And as the right-hand chart shows, mortgage interest payments as a percent of household incomes is going to continue to rise, and that's going to exert downward pressure. So that would be definitely something we'll be watching. And the second risk that we've identified is the UK budget. Now, again, playing into this idea of political stability, international investors purchasing UK assets potentially, does the budget and changes in the budget dent that attractiveness? And we'll be watching very closely about how much borrowing goes up, how much spending goes up, and where revenue raising policies are, particularly on the economy. The fiscal position is still challenging, to say the least. So there's going to be a lot of difficult decisions to make. But I think the key takeaway here is that I think we are in a sweet spot at the moment where a little bit of borrowing increase, a little bit more spending, a little bit more public sector pay increases keeps the Bank of England cautious in keeping rates, but if high, and that's supportive. But if we reach a tipping point like we did with Liz Truss, the situation is sharply different, we think, but it's definitely something we have to be mindful of. And the third risk that we see on the next slide, and this is the big elephant in the room, November's US presidential election. And that can have a huge impact, we think, on the dollar. It can have a direct impact on the UK. I've listed a few of them there. That's not exhaustive. We think a Donald Trump victory would see the dollar strengthen, so maybe sterling dollar does not rise as we currently expect. Right, so those are the three risks. And the final slide here is, what does this all mean? And you can see that we are expecting sterling dollar to rise, and we expect sterling euro to rise. I've put up our forecast for consistency against the Reuters FX poll. You can see that we're a little bit more optimistic on sterling. We're certainly not the most optimistic of strategists on the street at the moment, but we do expect sterling to do relatively well. Whether that actually comes through to fruition will be a function of those three risks of the relative growth, US politics, and the UK budget position. And that's it for my part of the presentation. There is a disclaimer that's going to come up just for consistency. These are our personal views. They are not a guarantee of what will happen. These are just our expectations of where currencies might move in the future, given a baseline. And with that, I will hand it over to Piers, who'll be running through the technical outlook rather than the fundamentals.
Thanks, Paul. Very interesting stuff. Right, so I'm going to kick off with the technicals. I feel a lot of people are under the misconception that markets and events are just driven solely by fundamental laws and news, meaning you can't time market turns and you can't predict them. My 40 years of studying the markets, charts tell me otherwise. They're around before modern day economics, just not as widely publicized. For myself, markets are driven by mathematical order and history, as it's usually the same sort of patterns, retracements, and cycles that happen time after time. Hopefully this presentation will help you see this. So we'll crack on with the first slide. So the first slide we have here is the dollar index. And on this is the yearly one. And I like to start with this because it shows the whole move down and then rally back up of dollar strength. You can see that on that green line, the 38.2%, 106.60. We've said all year that's capped dollar strength the last 3 years. It hasn't managed to close and hold above that. And again, we've fallen off that. So that's the big picture. But if we go to the next chart, because this is the quarterly charts we look at this webinar, you can see that for the last 5 quarters, but for 4 of them, it was capped exactly at that 38.2%. So is that coincidental or mathematical trading? So we've fallen off that 38.2% this quarter and a major move down. But where did it go to? It went to the support area we were talking about before, being down at the 99-100. We talked about that on previous webinars. On the last quarterly webinar, we talked about this importance of 99 to 100. And that's where price has gone down to. We also had the lowest quarterly close for the last couple of years. So that's significant. That's dollar weakness coming through there. But they haven't quite won. Remember that the market is just a battlefield between buyers and sellers. So yeah, the sellers have won. They've sold it off that 38.2%, but they've come down to where the buyers, we were expecting them to be. And the buyers have bought there. So you can see the little green rally off that pink line at the moment. So there is some dollar strength. So the dollar isn't quite written off at this stage. But if we start to see a move below 98.85, then I'd say we're going to see more dollar strength down towards probably the 93.95 area. So let's see how far we can rally in this rally off the 99-100 area. Where does price need to get back above to start to see some hope that there is a bit of a rally coming here? Well, the initial resistance is around about 101.60, but that's just small resistance. But 103.60 is where if price can get above there, it would ease this downward pressure that the dollar faced last quarter. Now, where does it have to get positive again? It needs to really get above that 106.60, but at least we need to see price up at 105.75, which seems a tall order at the moment. So keep watching that 99-100, see how far this rally goes. We'll keep updating. We've got the monthly webinar next month, and we'll see how we're going from there. But at the moment, the pressure is on that downside line. Right, we go to the next chart. We have euro dollar. So euro dollar here, I like this. This shows the whole move down from when it was 160.40 in 2008, just before the financial crisis. And I'll come back to 2008 and the financial crisis later on when we get to sterling. So we can see this is the move down. But if we go to the next slide, I'm hoping I've zoomed in on this. Yes, here we go. We've zoomed in. So last quarter, I've been saying for some time, look where the market stalled. The market has stalled from those lows that we had back in 2022 for the last 5-6 quarters. It's been capped by the 23.6% retracement and the 20-period moving average. That's just been the high. Coincidental or mathematically traded, I'm not sure. But that's been the high, that level, and it's capped it. Where's the support been? It's been the 38.2% of the move back up, around 104.66. You can see each time it got down there, it rallied. Now, it looked like this was going to break last week, and price did go higher. But into the close, and the close is the most important thing. Like you've been on a night out, the night's not over till you've got home. And here, it didn't manage to close above that 20-period moving average, which is currently about 110.95. So we haven't quite got the signal that the euro dollar is going higher, and that dollar weakness is there. We're closing again at that level, that 23.6, that 110.95, the 20-period moving average. So this quarter will be critical for the dollar. It has to see, can we pull away from there? Is it going to be a pull away from there back lower again, or is it going to go back up? Because if it goes back up, then the next resistance is round about in the 114.50, 115.50 area from that trend line that we have on there. So we could see a move back up there. But it'll be important because if it does get up to that 115 and hang around there, then it sort of opens up the question of the 120 area. But we haven't quite got that signal yet. That break could be happening. And I'd say that really, if we saw a move back below 109.50, then I'd start to say, maybe this isn't so good. If it got below 108.20, if we see it hold below 108.20, then I've sent out on my daily charts today, that could be a potential double top, and that could take us back down. So watch the 108, 109 area very closely, because this is where if euro dollar is going to find some support, it needs to find it in that area. And more importantly, as the quarter goes on, we need to see, if you want euro dollar higher, you need that above that 23.6 and that 110.95. While it's sort of holding below there, then there's a risk we just go back down and that resistance holds. So if we go to the next slide now, this is probably one of my favorite charts in my whole FX career. So if you trade sterling, this is all you've needed to look at. And if you do sterling cross against anything, this has helped you. It's another fine example of mathematical market work. We watched that 38.2% area on these webinars for years. From 2016, it held all the time. 2016, 2017, it capped every rally. We saw lots of times where people got excited and sterling was going to rally. A notable time was when Boris Johnson won the election. Everyone was so confident on sterling, but it never closed above that quarterly. It never closed quarterly above that 38.2%. When did it close above there? It closed above there last year, 2023. And I sent a mail out there saying sterling starts to strengthen from here. The negative time is over. And that was last year we sent that out. So since then, the 38.2% has simply switched from resistance to support. So whereas before, when price went up to that, the value of sterling, it got sold off. Now, when sterling goes down to it, it's being bought off there. So you had 3 quarters, so 9 months where it was the low. So it gave you the perfect opportunity for 9 months where to buy sterling against your currencies. And what it did, and it's funny, Paul said earlier that it's been one of the best performers this year, sterling. And that's because of this chart breaking last year. Last year, we warned you on these webinars, sterling was strengthening. And you can see it. What did it do? It went from the 38.2% to the 50%. It stalled at the 50%, and now it's gone up to the 61.8%. The amount of times we say on the webinars, a break of the 38.2%, you go to the 61.8%. Here's a great example of it. So what are we thinking of the levels at the moment? Well, we know where the 61.8%, that's at 69. And on the yearly chart, which I'll include when I do my January yearly charts at the start of year outlook, the 38.2% of the whole move lower on the big picture for sterling index is at 70. So this 69.70 area should be a tough area for sterling. So it'll be interesting to see how sterling copes when it gets up to this 69.70 area. I would expect there to be resistance there. Where should support be on pullback lower? Well, 67 area, around that 50%, should be your initial area you find support for sterling. Below that, the risk is you go down towards that 64, 50, 65 area, which is the 20 period moving average and 38.2%. Now, it's only below that 64, 50, 65 area that you have to start thinking that sterling has started a potentially longer term reversal rather than a pullback in this uptrend. So those are the levels I'd watch on the sterling index. You will get sent these slides with the writing. So if it was all a bit too fast, hopefully you'll be able to go through that. And remember, at any stage you ever want to go through these slides, talk to your salesperson, we can organize a call. So what does that look like on the currencies? Let's go and look first at euro sterling on the next slide. So this is euro sterling quarterly chart. In April, I highlighted on the quarterly webinars, you'd broken the uptrend line. And when you break an uptrend line, and that's been in place since 2016, it's down. You know, this is an uptrend, you break it, you're going lower. The target we gave was 84, which was the 38.2% of that whole move up. And you tested that as support last quarter. This quarter, it's broken, the quarter before last, we found that as support. Last quarter, the one we're talking about now, it broke below that 38.2%, 84. Now that's significant. So while you stay below that 86.54, which is the 20 period moving average, you can see each quarter it's sort of gone up there and failed. It stays negative, you know, and the risk is that we go lower. However, there are some support zones. Things don't normally go in straight lines. This has gone pretty much straight line since it's broken the trend line. But at the moment, I see support in the 82.50, 82.77 area initially, with maybe any pullbacks up towards 83.90, 84 having initial resistance, with stronger resistance at the 84.70, 85.40 area for this quarter. And as I said earlier, only above 86.50 has the negative feel completely gone and sterling's got some strength back. Sterling's lost its strength and the weakness is coming back. So those are the levels on euro sterling. I'll just quickly say on the next slide, the sterling euro levels. I know a lot of people here like sterling euro. Now this is slightly different. Again, we highlighted the break of the trend line in April. Look for a move higher. You know, it followed on from, if you see from 2023, when we talked about the break of the sterling index, it's only been going up since then, really. But the confirmation you got on sterling euro was in April, you broke above the trend line. We're coming to an interesting area on sterling euro because the 38.2, I never understand how they come out slightly different, these charts, but that's at 121.5 area. So you can see since the move down, every rally has stopped at 121.5. So again, I'd expect there to be some resistance around 121.5 area. Now, where could we go if we break 121.5? Probably up towards 123.15. Whereas support on pullbacks, well, before last quarter, I was saying watch the sort of 115.5, 116. That's the 20 period moving average and the 23.6% retracement. And those held well as support. You can see the market bounced off there last quarter and rallied up to the highs that it's at sort of now. So those are still big levels to watch, 115.5, 116. And that's where, if it gets below there, sterling euros had its day. But where's somewhere before that? Because that's somewhere away. So I'd look for support initially in that 119 figure 20 area. And that's the 84.90, sorry, the 83.90, 84 from the euro sterling chart. But what about below that? Because that probably could break if there's a sort of move down. I'd say the strongest support for this quarter is in the 117, 118 area. And that should hold, I feel, on any first test of it. And if it cracks there, then you're going to test that major long-term support at those levels marked on the chart. So we get to the final currency pair, which is sterling dollar. So this is the quarterly chart since 2007, 2008. It's another great example of how mathematical FX markets are. Because if we go to the next chart, remember this is showing you the high to the low. Look at that 23.6% retracement and the 20-period moving average. As I put there, again, is this coincidental or is it mathematically traded? I think it's mathematically traded because you had there for 5 quarters, that was the high, and the market couldn't break and hold above that area. But you can see last quarter, something changed with this positive sterling story and the negative dollar. It actually pushed through, and now this is clearly broken above, not like euro dollar. So what does that do? Well, it opens up a couple of upside targets if this is a confirmed good break and it holds. And they are sort of the 137 area, one from the Ichimoku cloud, the base of that yellow cloud. And it could potentially open up the 38.2% of 144, the 144 area. But what does it need to do to keep those targets live? It needs to make sure that if it comes back down, the support is still there for it and buyers are still interested in buying that market. So where should support be? Well, we always talk about the rule of polarity. Old support switches to resistance, old resistance switches to support. So in this case, you've broken above the old resistance at 129, 128, 25 is the 20-period moving average. So I would say the 128, 129, you need to see that hold on pullbacks on the quarterly chart for those higher targets to remain valid. If you start to get below there, then it sort of takes away that impulsive break feel, positive feel. But where does it actually change back to sort of looking a bit negative? That's below 127. So really, if you get back below 127, then it's going back to that negative feel. So we talked about resistance being at the 137 area from that Ichimoku cloud and the 38.2% of 144 area. But is there anything else that can help us? Because rule of confirmation is always good. More things that confirm, the better. So if you're on a pub crawl and 2 people say they want to move to the next pub, you need more people. You need a big percentage. So you're always looking for confirmation. The more people agree with something, the better. So here on the next slide, I've got the yearly chart, and this is the yearly long-term chart from 1980 to 1984. We've been in any of my training sessions. I always use this as the best example of how markets are mathematically traded, because I see this chart with all reasons why all these things happen, but they were aftersights. Oh, it fell because of this or it fell because of that. This gives you warning ahead. Now, what can we see? We can see those pink circles going across. That was the last retracement at 23.6%. So what that did each time the price came back down there, it used to bounce off there. That was an area the market would buy. Oh yeah, we buy it here, we make money. But that changed in 2016. We broke down below it. And since then, you haven't had a yearly close above it. It's tried quite a few years to get up to that level and break it, never closed above it. Where is that? 136.97. So that's about 137. So that's another reason why I think the 137 area will be key in a lot of people's mind. And it will be important to see how the year closes, how this quarter closes, because that would be the yearly close against that 137 area. And that would be important. We'll cover that in the January start of year outlook. We'll look at this chart again and that will help us form our view for next year. But finally, we have the elephant in the room for me. And I said this is the elephant in the room all year. And it's the next slide, the 8-year cycle. So every 8 years, sterling dollar has collapsed. And I sat in the dealing room twice and people say, oh, you're wrong on this. And then something's happened that has completely collapsed sterling. Now, it worries me at the moment because at the moment, I hope this 8-year cycle doesn't complete and we see a break with the 8-year cycle because we're having a positive year so far. But what worries me, especially with world events, is that something bad happens that's not on people's radars and sterling collapses. Sterling dollar collapses. Something could happen that strengthens the dollar, that pulls it down, that weakens sterling, that pulls it down. So, as I said, I hope I'm wrong with this cycle because the world just doesn't seem in a good place. And I can only think it's something bad that's going to bring it back down. But it's not all rosy. It's not all rosy for sterling dollar until we get the end of the year close, and that is looking positive. So on that lovely doom and gloom note, I will leave you with the disclaimer and pass you back to Paul.
Thanks very much, Piers, for that. Super interesting. I think you've mentioned how the outlook for sterling might have changed. There's certainly some key levels that we need to be watching into the end of the year. Sterling certainly has had a good year so far, but with your last chart, there's always a reminder that what's happened in the past might not continue to happen in the future. So we'll watch those risk events very carefully. So I think we'll bring the webinar to a close. I'd just like to say thank you very much for dialing into today's webinar, and we look very much forward to seeing you in November, where we'll be turning our attention to the US presidential election, one of those 3 risks that I mentioned about in terms of the sterling outlook, but it will have fundamental impact on the dollar. So please dial in next month.